Now we will take a look at Target's financial information. Target's revenues have been holding pretty steady for the last 3 years at just above $70 billion, which hardly shows a change from previous years. However, you will notice that their net income has been dropping pretty steadily for the last 3 years, from just under $3 billion in 2013 to a loss of $2 billion in 2016. Now, when we look at the debt-to-asset ratio, this will show the ratio that is funded by debt as opposed to equity. With this ratio higher, the number would indicate funding by debt, and a lower number would indicate funding by equity. Looking at Target has a debt-to-asset ratio of 0.66, which shows that 66% of Target's assets are financed by their creditors, and only 44% of assets are financed by the corporation owners. Now let's take a look into the inventory turnover. This is the number of times per year that the inventory turns over. Analyzing this ratio can be difficult since sell inventory levels are likely to change throughout the year. When comparing Target to Walmart, you will see Target was at a 6.16 and a Walmart was at an 8.11. This would indicate that Walmart's inventory turnover more times a year than Target. The statistic infers that Walmart potentially sells more goods and services than their competitor Target. Now, the last ratio we will look at will be the earnings per share ratio. This ratio will express the corporation's net income after taxes per share of stock. Earning per share ratio is a reflection of the dividends that each common share of stock would have earned. Last year, Target earned $72 billion in total revenue. However, that wasn't their gross profit since they spent $51 billion to cover the cost of revenue. However, they still grossed a total of $21 billion, which is $100,000 more than 2014.